Hey guys, welcome to this fascinating video where we'll answer an intriguing question that has been on the minds of many. Could 2023 be the year when Bitcoin takes a giant leap forward with the introduction of a Bitcoin ETF? Well, we all know how Bitcoin has captured the imagination of countless investors, and now the possibility of a Bitcoin ETF has become the hottest topic of discussion. So guys, join us as we delve into the world of Bitcoin ETFs, discovering what they are, the potential benefits they offer, the current regulatory landscape surrounding them, and the key factors that could influence their approval in the year ahead. With that said, get ready for an eye-opening journey as we uncover the potential future of Bitcoin ETFs. First and foremost, let's try to understand the concept of a Bitcoin ETF. An ETF or exchange-traded fund is a special type of investment that follows the ups and downs of something valuable or a group of valuable things. It helps people invest in a mix of different things, kind of like a money pool, but with the extra perk of being able to buy and sell it on the stock market during the day. A Bitcoin ETF is a particular kind of ETF that's made to keep track of the price of Bitcoin. Instead of directly buying and holding Bitcoin, people can buy pieces of the ETF, which show that they own a part of the Bitcoin that the fund has. The ETF's performance matches how Bitcoin's price changes, so people can invest in Bitcoin without actually having the cryptocurrency themselves. A Bitcoin ETF has a few good things about it. With a Bitcoin ETF, people can invest in Bitcoin without having to deal with the complicated stuff of cryptocurrency exchanges or keeping their private keys safe. It's a familiar way of investing that they can use through regular brokerage accounts. Investing in cryptocurrencies can be confusing for people who are new to it because there are technical things to figure out and security worries. A Bitcoin ETF makes things easier by offering a regulated and standard product that professional money managers take care of. Some investors, like big pension funds and big asset managers, have rules they have to follow and like to use investments that are regulated. If a Bitcoin ETF was available, these big investors could join in and help make the cryptocurrency market bigger and more stable. Now let's look at the regulatory landscape. Getting permission to have a Bitcoin ETF has been a tough journey because of some rules. If a Bitcoin ETF is allowed, it would make it easy for regular people in the US to invest in Bitcoin without the trouble of setting up a digital wallet or dealing with complicated crypto exchanges. It would also give rich investors like big money families a chance to put their money into a Bitcoin product that follows the rules and keeps their money safe. That's why supporters want the Securities and Exchange Commission to say yes to the ETF. The people who make the rules have been cautious about saying yes to Bitcoin ETFs, and in the past they have said no to many applications. They usually say no because they are worried about some things. Here are some common worries. The people who make the rules are concerned about bad people manipulating the Bitcoin market. Since Bitcoin is still new and not as controlled as other financial markets, they worry that bad people could do things to make the ETF not work well and make it risky for investors. Keeping Bitcoin safe and secure is important. The people who make the rules are worried that there aren't good and reliable ways to keep Bitcoin safe. They want to make sure the investors' money is protected and that there are good plans in place to stop Bitcoin from being stolen or lost. The people who make the rules have to make sure that investors are protected. They want to make sure that investors have the right information about the Bitcoin ETF and know the risks involved. They also want to make sure that there are ways to stop fraud, make sure the price is fair, and give investors a way to get help if something goes wrong. So what is SEC's standpoint? Over 2 years ago, the Ontario Securities Commission gave the green light to the first Bitcoin exchange-traded fund in North America, raising hopes that a similar product could be approved in the United States. In 2021, the U.S. Securities and Exchange Commission approved the first Bitcoin futures ETF, paving the way for other similar offerings. Currently, there's no spot Bitcoin ETF trading in the US, but BlackRock's recent filing suggests that this may change soon. In the past few weeks, several new applications for a spot Bitcoin ETF have emerged, indicating that the market may have evolved enough to support such an ETF. The big question is whether these companies can provide enough assurances to the SEC that an ETF would be safe. One notable difference is that the recent applications are focusing more on their surveillance sharing agreements, which involve sharing information about market securities. Coinbase, a major cryptocurrency exchange, will serve as the trading platform for these potential ETF issuers, including Nasdaq and Cboe BZX, on behalf of BlackRock, Fidelity, VanEck, and others. The SEC has raised concerns about surveillance sharing agreements before. In 2019, the regulator rejected a Bitcoin ETF application from Bitwise, citing the potential for market manipulation and the need for a surveillance sharing agreement with a regulated market of significant size to prevent such manipulation. A challenge lies in the lack of a clear definition for what constitutes a regulated market of significant size, according to James Seyfarth, an analyst from Bloomberg Intelligence who has been following Bitcoin ETF applications for years. Typically, the SEC tends to delay and then deny these applications throughout the process. They sometimes provide comments. Some of these discussions may occur behind closed doors. Coinbase is clearly the largest cryptocurrency exchange in the United States, with significantly higher trading volume than its closest competitor, Kraken. The majority of this volume comes from its Bitcoin market. Even the SEC recognizes Coinbase's prominent role in the US, as stated in its lawsuit against the exchange. However, this lawsuit is unrelated to Coinbase's Bitcoin market, which likely contributes to these companies considering Coinbase as their surveillance sharing agreement partner. The question remains whether the SEC will acknowledge Coinbase as a regulated Bitcoin market of significant size and whether such recognition is necessary for approval. Last year, the regulator seemed to believe that there was no regulated market for Bitcoin. When approving Ethereum's Bitcoin futures ETF, the SEC noted the spot Bitcoin markets are not currently regulated. This raised the issue of why surveillance sharing agreements for Bitcoin market futures would not work for spot ETFs. In contrast, the BlackRock Nasdaq filing argues that a significant regulated market is not essential, citing past ETF rejections. The filing emphasizes that the Act does not require the spot Bitcoin market to be regulated for the SEC to approve the proposal. It further states that while unregulated currency and commodity markets lack the same protections as overseen markets, the SEC has consistently considered surveillance sharing agreements with underlying futures markets to determine the suitability of such products. According to the filing, the Bitcoin futures market should meet the SEC's significant size requirements. The Securities and Exchange Commission (SEC) will likely consider the maturity of the Bitcoin market, including factors like liquidity, stability, and concerns regarding market manipulation. They will also evaluate the presence of strong surveillance mechanisms, such as surveillance sharing agreements, which play a crucial role in monitoring and preventing manipulation. Additionally, the existing regulatory framework for cryptocurrencies will be assessed, along with any proposed regulatory changes or developments that may impact investor protection. Reputable institutions like BlackRock, Fidelity, and Nasdaq entering the market add credibility and trust. Institutional participation can also contribute to market expansion and liquidity, and potentially reduce volatility, all of which the SEC may consider when evaluating a Bitcoin ETF proposal. Similarly, keeping to regulatory compliance measures by institutional investors addresses some of the SEC's concerns regarding investor protection and market integrity. The global regulatory landscape and the approval of cryptocurrency-related investment products in other jurisdictions may serve as a guide and influence the SEC's approach. Clearer guidelines and specific regulations targeting cryptocurrencies could create a more favorable environment for ETF approval. It's also essential to keep an eye on any updates in the SEC's guidance regarding cryptocurrencies and investor protection. Public opinion towards cryptocurrencies and efforts by relevant stakeholders can indirectly impact the SEC's decision-making process through political pressure or shaping regulatory priorities. Alright guys, that wraps up our video for today. Thanks for watching. If you're interested in staying updated on all things crypto, make sure to hit that subscribe button. By subscribing to our channel, you'll be the first to know about any new developments, regulatory changes, and market insights regarding the Bitcoin ETF.